There is a particular kind of silence that precedes a seismic shift in the financial order of things. Not the silence of calm, but the silence of a world that has not yet noticed what is already happening beneath its feet. We are living inside that silence right now. And if you are watching this, you are about to have it broken. Spot climbed towards $79 per ounce this week, with COMEX futures briefly touching $80.21 intraday on the 7th of May 2026. Let that number settle in your mind for a moment. Not because $79 is the end of the story, it is emphatically not, but because of why it is there. And more critically, because of what the mainstream financial press is not telling you about the architecture beneath it. Gold, meanwhile, has been trading above $4,700 per ounce, having peaked at an all-time high of $5,722 on the 28th of January 2026. The gold-silver ratio, that ancient monetary measuring stick, has narrowed sharply to approximately 58-1. The market is beginning slowly to recalibrate, but the recalibration has barely started. The catalyst the cable dust fixated on this week was a confirmed Axios report. The United States transmitted a one-page memorandum of understanding to TAN through Pakistani mediators proposing enhanced United Nations inspections, a halt to nuclear enrichment for 12 to 15 years, a potential transfer of highly enriched uranium abroad, and limitations on underground facilities, all in exchange for a graduated lifting of American sanctions and the unfreezing of billions in frozen Iranian assets. Crude oil tumbled on the news, inflation expectations softened, and silver, counterintuitively to the untrained eye, surged. Anyway, here is where the analysis must grow more serious because the surface reading of these events is insufficient to the moment. The Federal Reserve Bank of Chicago President Austin Goolsbee went on the record on the 7th of May with a statement that deserves to be read not once but twice in measured silence. He warned that inflation has not continued to cool toward the central bank's 2% target and has in fact accelerated since the outbreak of the war. Read that again. A sitting voting member of the Federal Open Market Committee publicly stated that core inflation accelerated through the war period and silver rallied regardless. That is not a contradiction for those who understand what silver is pricing. This market is not responding to the pre-war disinflation path that the cable desk keeps projecting onto the screen. It is pricing a post-war environment in which a potential Iran agreement removes the ceiling on energy prices while the structural inflation residue from 2 months of active conflict remains embedded in the economy for quarters to come. Services inflation, supply chain rerouting costs. The elevated insurance premiums on Persian Gulf shipping that do not simply evaporate because a memorandum of understanding changes hands between diplomats. The durable cost pass-through is already inside the system. Silver is not celebrating peace. Silver is telling you that the monetary environment that produced $79 silver was built on something far more permanent than a geopolitical headline. And yet, and here the intellectual discipline of honest analysis requires us to pause, the bearish case is real and it must be given its due. Silver at $79 per ounce sits approximately 35% below its all-time high of 1,167 set on the 29th of January 2026. A correction of that depth, less than 4 months from a historic peak, has historically preceded multi-year consolidation phases, not vertical reacceleration. The Iran memorandum has not been signed. Tehran is reviewing. Prior Hormuz's adjacent peace signals have collapsed twice this year already. And if this proposal collapses too, oil retraces higher, energy CPI follows, the Federal Reserve freezes, and the paper price ceiling on silver reasserts with a force the bulls in this market may not be prepared to absorb. There is also the matter of AGQ, the ProShares Ultra Silver Leveraged ETF, which was the subject of a published 247 Wall Street analysis on the 4th of May 2026, warning that open interest in COMEX silver futures has dwindled toward 100,000 contracts as physical demand pulls metal off the exchange. The analysis placed on record a tail risk of delivery default that could disorderly unwind COMEX silver pricing entirely. That is not fringe commentary. That is a published Wall Street document 4 days old as of this recording describing a structural crack in the paper market that most retail investors have never been asked to contemplate. Saver ETF outflows remain elevated over $3 billion year to date in primary fund redemptions, which documents capital exiting the paper silver vehicle, not entering it. Hold that fact alongside the price rally and you begin to understand that the two things are not in conflict. They are in fact the same story told from opposite ends. Because if you are wondering how a commodity can rally while its paper instruments bleed capital, the answer is that it is no longer behaving as a commodity. Something has changed. And if you stay with me through what comes next, you will understand exactly what. If this kind of analysis, sourced, documented, unsponsored, is the kind of desk you have been searching for, then now is the moment to subscribe. Because what I am about to show you in part 2 is not a theory. It is a supply collapse hiding in plain sight. And the clock on it expires inside 12 months. In the long sweep of economic history, there is a particular category of crisis that civilizations consistently fail to perceive until it is upon them. Not for lack of evidence, but for lack of the willingness to follow the evidence where it actually leads. The depletion of a critical resource does not announce itself with a klaxon. It announces itself with a data point that sits quietly in a technical report that almost nobody reads until the day that data point becomes the only thing anyone is talking about. Mexico is the world's largest silver-producing nation. It has been for the better part of a decade. And here is what the Silver Institute's corpus documents without drama and without apology. Mexico's known silver reserves have dwindled to approximately 37,000 metric tons against an annual production rate averaging approximately 5,600 metric tons per year. The arithmetic is not complicated. At the current pace of extraction, Mexico's silver reserves are projected to be exhausted by the end of 2026, not 2040, not 2035, the end of this calendar year. Production is now declining at double-digit percentage rates annually for the first time in nearly a decade. Newmont's Piasto mine, one of the largest silver operations on the planet, removed approximately 16 million ounces from this year's expected output alone due to operational suspensions. Peru, the world's third largest silver producer, saw output decline approximately 5.8% year-on-year in 2023, with the Silver Institute's 2026 forecast projecting continued declines from operations including Nexa Resources, Cerro Lindo, and Buenavur's Tambo. The Silver Institute's own 2026 projection has global mine production barely climbing 1% year-over-year to approximately 820 million ounces against forecast demand of 1.2 billion ounces. That is not a minor imbalance. That is a structural gap of roughly 380 million ounces in a single year, compounding onto a cumulative supply deficit from 2021 through 2025 that has already reached approximately 820 million ounces. One full year of total global mine output gone from above ground stocks over 5 years and not replaced. Average all-in sustaining costs for primary silver miners now sit at approximately $21 to $23 per ounce. Average ore grades at new discoveries have declined to approximately 150 to 200 gram per ton compared to 300 to 400 gram per ton at currently operating mines. The geological reality is stark. The easy silver has been found and extracted. What remains in the ground is harder to reach, more expensive to process, and available in smaller concentrations. The optimistic counter-argument that substantially higher prices will reopen marginal deposits and accelerate recycling is not without merit. The Silver Institute's own forecast projects global mine output to grow 1 to 1.5% in 2026, with new operations from Heckler's Keno Hill and other projects partially offsetting Mexican and Peruvian declines. Silver recycling currently provides approximately 200 million ounces annually, but solar panel recycling is structurally constrained because most installations from the early 2000s solar boom remain operational, and most industrial silver use is dissipative across tiny components that are simply uneconomic to recover. Now enter the lease rate signal. The single most important metric that the financial press, occupied as it is with geopolitical headlines and Federal Reserve minutes, has almost entirely failed to explain to its audience. In a normal market, 1-month silver lease rates sit between 0.3 and 0.5% annualized. By January 2026, that rate had exploded to approximately 8%. 3-month lending rates touched 5.5%. At points in the fourth quarter of 2025, the silver forward rate touched levels in negative territory, meaning the borrower was willing to pay rather than earn interest simply to be assured of physical delivery. Sit with that. A borrower paying for the privilege of being guaranteed physical metal. That is not a quirk of derivatives pricing. That is a market screaming that the physical commodity is becoming scarce in ways the paper price has not yet fully acknowledged. The exchange for physical spread, the gap between COMEX futures and London spot, tells the same story from a different angle. The historic average is approximately 25 cents per ounce. The current EFP spread has run as high as A1 and 10 and currently sits near 97, roughly 4 times its historic norm. Every COMEX silver futures contract through late 2026 is trading below the current spot price. That is persistent backwardation across the entire forward curve. The market explicitly pricing physical scarcity that lasts years, not weeks. LBMA-eligible silver stocks had shrunk to approximately 155 million ounces, while floating annual demand was running between 900 million and 1.2 billion ounces. The notional COMEX paper-to-physical ratio at one point reached as high as 356 to 1. There is no functional analog to that leverage structure in any other commodity market on the planet. Andrew Maguire of Crises has been publicly on record stating that if backwardation deepens further, multi-doll permanent spreads could force a complete reset of price discovery toward the Shanghai Gold Exchange and other physical settlement venues. The currency of that claim is not ideological. It is structural. When a paper market's link to the physical commodity it purports to represent begins to crack, when lease rates explode, when EFP spreads quadruple, when the forward curve inverts entirely, the question is not whether the repricing will occur. The question is only the timing. And the timing, as it turns out, has just been materially accelerated by decisions made not in New York or London, but in Moscow, New Delhi, and Beijing. What I'm about to tell you in part 3 has been hiding in government budget documents, central bank directives, and Ministry of Commerce filings for the past 6 months. It has not been assembled in one place for one audience with the primary sources identified until now. Stay with me. There is a phrase that recurs in the study of monetary history with uncomfortable regularity. By the time the public understands what has happened, the repositioning is complete. The great monetary transitions of the 20th century, the abandonment of the gold standard in 1933, the closure of the gold window in 1971, the demonetization of silver in 1965, were not announced with fanfare to the citizenry in advance. They were executed, documented in official records, and then explained to the public afterward when the geometry of wealth had already been rearranged. We appear to be living through another such rearrangement. And unlike the ones that preceded it, this one has left its fingerprints in public documents available to anyone willing to read them. Russia's draft federal budget for 2025 through 2027 explicitly allocates approximately $535 million to precious metals acquisition for state reserves. The document explicitly names silver alongside gold, platinum, and palladium. This is the first time a major central bank has publicly declared the inclusion of silver in state reserves during an active precious metals bull market. Russia is not buying silver as a commodity hedge. Russia is buying silver as a sanction-resistant strategic monetary asset in the same regulatory category as gold. The political backdrop is not subtle. The freezing of approximately $300 billion in Russian foreign reserves following the 2022 Ukraine sanctions converted dollar-denominated reserves into a sovereign risk category for every emerging market central bank watching. The lesson was absorbed. The response documented in Moscow's own budget filings is now active. India's trajectory is more expansive still. Per published estimates compiled by independent analysts, India has acquired more than 900 million ounces of silver over the past 5 years through government channels, corporate stockpiling, and household accumulation, a figure that exceeds reported LBMA holdings over the same window. India's silver imports surged approximately five-fold year-on-year in October 2025, a surge that metals-focused analysts directly attributed to anticipatory demand ahead of a regulatory change that went into effect on the 1st of April 2026. That regulatory change is the Reserve Bank of India's new directive formally permitting silver jewelry, ornaments, and coins as collateral for loans across all regulated entities, commercial banks, and non-banking financial companies alike. Until that date, only gold could be pledged as collateral in the Indian banking system. The directive embeds a specific structural ratio. Borrowers may pledge up to 10 kilos of silver versus 1 kilo of gold for loans up to 2.5 lakh rupees, with loan-to-value extending to 75% of assessed metal value. That is a 10.1 collateral ratio between the two metals. Compare it to the gold-silver market price ratio sitting near 58:1. India, the nation that holds the world's largest private precious metals reserves, including an estimated 34,600 tons of gold in household form, has just formally activated its dormant household silver holdings as bank-eligible collateral at a monetary ratio that implies silver is dramatically undervalued relative to gold at current prices. That is not a regulatory curiosity. That is a state-level monetary endorsement encoded into banking law. China has moved on the supply side with equal deliberation. On the 1st of January 2026, China's Ministry of Commerce implemented a new licensing framework for silver exports, replacing a long-standing quota system with strict state permission requirements. The framework requires exporters to demonstrate at least 80 metric tons of annual silver production capacity and $30 million in credit lines, a threshold that by design eliminates small and mid-sized exporters from international shipment eligibility. The Chinese state-run Securities Times, citing an industry insider, stated explicitly that the new policy elevates silver from an ordinary commodity to a strategic material, placing its export controls on the same regulatory footing as rare earths. Per analyst estimates cited in published trade reporting, the framework restricts approximately 60 to 70% of global silver supply to domestic Chinese use. Initial reports from the first quarter of 2026 indicate Chinese silver export volumes have already been reduced by up to 40% compared to the prior year baseline. The parallel signal from Washington arrived in November 2025 when the United States Geological Survey added silver to its nationally designated list of critical minerals, explicitly citing silver's roles in electrical circuits, batteries, solar cells, and antibacterial medical instruments. Both superpowers simultaneously independently within a 60-day window formally reclassified silver from a commodity to a strategic asset. For the first time since the United States demonetized silver in 1965, the world's two largest economies have reached the same conclusion about what silver actually is. And the COMEX futures price denominated in fiat dollars remains at this moment the only major silver pricing benchmark on the planet that has not been updated to reflect that reclassification. The final layer is the demand pipeline that most analysts cannot model because it sits in technology infrastructure that did not exist 5 years ago. According to published analysis of the silver supply chain, approximately 20 metric tons of silver are required per gigawatt of installed photovoltaic capacity. A single 500 megawatt solar array, enough to power one hyperscale artificial intelligence data center, requires approximately 300 metric tons of silver. Goldman Sachs published research projecting that data center power demand will rise approximately 165% by 2030. The International Energy Airways published projection has data center AI and crypto electricity demand approaching 1,000 terawatt hours annually by the end of 2026. The Silver Institute's December 2025 forecast confirms that data centers and artificial intelligence-related technologies will be primary drivers of silver industrial demand growth through 2030. There is no published industrial substitute that has cleared deployment-grade testing. And yet, solar photovoltaic demand from this sector alone is forecast by metals focused to intersect with an already strained supply picture in ways the spot price has not yet fully absorbed. Industrial photovoltaic demand is forecast to decline approximately 19% in 2026 to around 151 million ounces, partially offsetting the AI data center tailwind. But the structural trajectory beyond that point is not ambiguous. Here then is where the data stands. As of the 8th of May 2026, spot silver near $79 per ounce. COMEX futures having touched $80.21 intraday. Gold's all-time high at 5,622. Current spot above 4,700. The gold-silver ratio at approximately 58 to 1. Mexico's silver reserves projected to be exhausted by the end of this year. The cumulative global supply deficit from 2021 through 2025 at approximately 820 million ounces. One full year of global mine output gone. 1 month lease rates at 8% against a historic norm of 0.3 to 0.5%. The COMEX paper-to-oil ratio having touched 356 to 1. Russia with an openly declared central bank silver reserve program. India with 900 million ounces of documented accumulation and a 10-to-1 banking collateral ratio now active in law. China with 60 to 70% of global supply behind state licensing. The United States and China having simultaneously classified silver as a critical strategic mineral, and every hyperscale AI data center coming online in 2026 requiring 300 metric tons of silver to power its solar supply chain. The bearish arguments are real. They deserve respect, not dismissal. A correction from the January all-time high of this magnitude has historically preceded consolidation. The Iran deal may collapse. Russia's 535 million allocation is meaningful but small in absolute terms. India's 10.1 ratio is a domestic banking parameter, not a global monetary repricing decree. China's export licensing framework is not a blanket ban. Silver continues to ship under approved licenses. These are not straw men. They are legitimate constraints on the most aggressive forward projections. But when the lease rate signal, the EFP signal, the entire forward curve, a published Wall Street delivery default warning, the first openly declared central bank silver reserve program in modern history, a 10-to-1 monetary endorsement from the world's largest democracy, and a dual superpower strategic reclassification all arrive in the same analytical frame at the same moment. The honest obligation is not to soften that convergence. It is to document it, source it, and place it before you without editorial distortion. That is what this desk exists to do. Drop a comment below with one word, the single factor in this analysis that surprised you most, not for the algorithm, because your answer will tell me what to build next. And this community has earned the next layer of this story. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in